Hello everyone, welcome to Yadnya Investment Academy. Today we are going to discuss about the topic TDS. TDS is simply tax deducted at source. TDS is a direct tax which is collected from the people at the time of payments like salary, fees, commission, etc. to them. The TDS collected is then transferred to government account. The concept of TDS requires that the person or organization on whom responsibility has been cast to collect TDS, called as deductor, is to deduct tax at the appropriate rates from payments of specific nature which are being made to the specific recipient, called deductee. Deductor is mostly the buyer of the product or services, and deductee is the seller of the product or services. We will discuss few of these payments and rates in this video later. TDS collected by deductor is then deposited in the bank, which in turn deposits it to government's account with income tax department. Deductee gets the credit of the TDS deducted in his personal income tax assessment on the basis of the certificate issued by the deductor. Let us take an example of TDS, assuming the nature of payment is professional fees on which specified rate is 10%. Suppose Yadnya Limited makes a payment of Rs 50,000 towards professional fees to Mr. Rahil. Then Yadnya Limited shall deduct a tax of Rs 5,000, that is 10% of Rs 50,000, and make a net payment of Rs 45,000 to Mr. Rahil. The amount of Rs 5,000 deducted by Yadnya will be directly deposited to the credit of the government, and it will issue a certificate to Mr. Rahil stating the same. The significance of the TDS to the government lies in the fact that it prepones the collection of tax, ensures a regular source of revenue for the government, and provides for a greater reach and wider base of tax. At the same time, for the taxpayer, it distributes the incidence of tax and provides for a simple and convenient mode of payment. The one question that comes to mind is, how is TDS different from income tax? TDS is actually part of the income tax you pay only. You can look at it as a pay-as-you-earn scheme where your company deducts an equitable amount of tax every month from your salary, which practically saves you from the burden of making a lump sum payment at the end of the financial year. Once you calculate your tax for a particular financial year and it comes out to be more than the TDS, then the excess amount needs to be paid to the government as tax. And in case where the TDS amount deducted is higher than the tax computed, then you can file for a TDS e-returns and the extra amount will be reimbursed. One more question we should discuss is TDS applicable only on salary? Answer is no. TDS is also applicable on items such as income from interest on savings, fixed and recurring accounts, securities and deemed dividends, income from horse racing and insurance commissions, lottery or game related prize money, payment in NSS deposits, etc. Now let's discuss few of these items and their current TDS rates and threshold limits. Threshold limit is level of payment only after which TDS will be deducted from future income or payments. TDS is deducted as a percentage of overall payment and may range from 1% to as high as 30% of actual payable amount. If you pay attention to this table, TDS rate on salary is based on our tax slab. TDS rate on interest by instruments such as fixed deposits and savings account is 10%. Lottery winning or winning from horse race is 30%. Brokerage and commission TDS is 5%. And TDS on rent of plant and machinery is 2%, and land or building is 10%. Now there are many TDS exemptions as well, such as amount is paid to RBI or government or any such body, then the TDS is exempt. Interest or gains from mutual funds, the TDS is exempt. Or when the deductee has a non-deduction certificate under section 192, then also the TDS is exempted for that deductee. Similarly, when the interest is paid or credited to these type of accounts, the TDS is exempted in that case too. Remember, if tax is not deducted at source, that is TDS has not been cut, then it does not mean that one is not required to pay tax. TDS just prepones your tax incidence. It doesn't extinguishes it. There are few important points we should note about TDS. As per Income Tax Act, TDS deductor need to have tax deduction and collection account number, that is TAN number, as it is compulsory to mention it when filing TDS returns. The deductor needs your PAN number to deduct TDS. TDS certificates Form 16 for salaried individuals and Form 16A for non-salaried individuals is issued by deductor. These need to be presented to adjust TDS amount paid against the total payable tax by you. Here it is important to understand how TDS is linked to your PAN. TDS deductions are linked to PAN numbers for both deductor and deductee. If TDS has been deducted from any of your income, you must go through the tax credit form 26AS in your e-filing portal. This form is a consolidated tax statement which is available to all PAN holders. Since all TDS is linked to your PAN, this form lists out all the details of TDS deducted on your income by each deductor for all kinds of payment made to you, whether those are salaries or interest income or lottery income, whatever it is. All TDS linked to your PAN is reported here. This form also has income tax directly paid by you as advance tax or self-assessment tax. Therefore, it becomes very important for you to mention your PAN correctly wherever TDS is applicable on your income. This is all we have on this topic. If you have any question, please do write in the comment section below. Have a great day ahead.